Well, it's another rate rise surprise. Hi everyone, welcome to the weekly market update. Today is Tuesday the 6th of June, and just before I get into it, you do need to be aware that anything I say is general advice only. So it doesn't take into account your personal financial circumstances, and you have to decide if what I'm saying is appropriate for you. Today was RBA day, and we've had another quote-unquote unexpected rate rise from the RBA, another 0.25%, lifting the RBA cash rate to 4.1%. So again, we've had a situation where probably the majority of economists, the majority of commentators have said the RBA is probably not going to raise this time, and in fact they did raise. And really I'm not sure why the economists were feeling that they'd wait, because CPI is still extremely strong. CPI came in at 6.8% for the year to May, well above the 2 to 3% target range. We've seen a lift in the awards wages, which will put wage price pressure on inflation. We've seen house prices tick back up. We've seen rental prices rise. We've got a large migrant intake coming, and overall there's a lot of inflationary pressures in our economy. And so in that scenario, it's very hard to see the RBA holding. So they didn't hold, they lifted rates, and they did say there's the potential for more rate rises moving forwards. Going to have to look at the data moving forwards. We will see GDP tomorrow. That's expected to come in fairly strong. I'll touch on that in a moment. But unemployment's still very, very low. Wage price growth, not great to be honest, but still there. And a lot of inflationary pressures. So a rate rise was not too surprising. It did help the Australian dollar push back up, and that will reduce imported inflation, which is a good thing. And we'll sort of perhaps reduce some of the wealth effect of the recent lift in house prices. And to be honest, I don't think it should have been too surprising to the market. But it was taken as a bit of a surprise before the announcement. The XJO was down about 40 points. After the announcement, it was down about 80 points. And so we did see a fair bit of sort of shocking selling come from the market. A lot of this was concentrated in the domestically focused stocks, your financials, some of the other sort of discretionary related stocks as well here. And the more overseas focused stocks like the miners and equivalents fared a bit better after the announcement. So it was a little bit surprising to the market. We did see the selling, but overall it should not have been unsurprising, given that the inflation battle is far from over. In fact, the RBA themselves doesn't see inflation getting within the target range till at least 2025. So not surprising to me, not surprising to some of us here, but it was a bit of a surprise for the market, which did see some selling. So the next thing I wanted to touch on is Australian GDP. So we will see first quarter GDP released tomorrow morning, and that's expected to come in around 2.3, 2.4%, which is still a very, very strong number. So economic growth still very, very strong. A lot of that is price growth, I guess, but it is still a sign that the economy is still ticking along nicely, despite the rate rises that we've had. Obviously this is mostly past looking data, so it's the first 3 months of the year, so only up until March. So it won't really give us a good idea of how the economy is tracking at the moment, or how it's tracking, going into the second half of this year. But it is expected to show, that the first part of this year was fairly strong. And that did coincide with, a lot of other sort of strong economic factors. So unemployment readings at that time were very, very low. House prices bottomed out and started to rise at that time. And other sort of economic indicators were fairly strong as well. So GDP still expected to be going strong, but like I said, it is backwards looking. It only goes up until March, and I think the period since March is where we've seen economic weakness start to creep in. Finally, I did want to touch on oil. We've seen oil prices be a bit volatile recently. They also remain pretty close to their yearly lows at the moment, and that's despite a recent OPEC production cut. So OPEC over the weekend announced just over 1 million barrels, I think 1.4 million barrels of production cuts. The majority of that was Saudi Arabia. The remainder of the OPEC nations barely announced any cuts at all. In fact, some of them are probably going to increase production. And this is an interesting thing. Saudi Arabia wants to support oil prices. They want prices higher, so they'll cut and they'll do the majority of the cut. But for the other nations, they kind of need their oil production. Obviously, they want oil prices higher, but they borrow a lot of US dollars. They've borrowed a lot of money in US dollars. The US dollar is extremely strong, and the cost of borrowing in US dollars has gone up quite a lot. So if you're a small or developing nation, or a BRICS nation, or something like that, that has a lot of oil production, but also has a lot of US dollar borrowings, you need to keep making as much money as possible to finance that increased cost of US dollar borrowing and that increased cost of acquiring US dollars. So a lot of these countries, even though they want oil prices higher, they simply can't afford to cut their production, because otherwise they might not be able to pay back their US dollar borrowings. So there was an initial jump from the Saudi Arabian production cut announcement, but since then we've seen oil prices come back off. And it mirrors the move that we saw in May, where we saw OPEC, or Saudi Arabia again, announce production cuts, and there were a couple of days of strong gains, and then oil prices started coming back off once again. Oil might be, in this case, a bit of a leading indicator of economic activity, and it might be an indication that we are going to see a bit of an acceleration to the global economic slowdown as we go into the second half of this year. Alright, so let's have a quick look at the charts, a quick look at the technicals. This is the XJO, the top 200 stocks in Australia by market capitalization, and we can see that it's still inside this giant pennant pattern. We've got this medium-term downtrend that's formed since the highs of February. We've got this gradual longer-term uptrend line that's formed since late last year. We've recently tested both sides of this pennant, and we seem to be heading right into the point of this pennant. So until any of these lines break, it's very hard to call a directional move on our market. We've got a support level at maybe 71.10, 71.15. That's also where the 200-day moving average sits, and not far below that is the gradual uptrend line. If these levels break, we could expect to move back to 7,000 and then perhaps 6,900, while a break to the upside would have to break the downtrend line and then resistance at about 72.80 before further gains will look likely. Overall, you usually expect things to break in the direction of the longer term trend, so usually you'd expect a break to the upside. However, I'm not sure that's going to be the case for our market this time around. We've got plenty of downwards pressure on our market. We had the RBA rate rise today. We've got potentially weakening economic fundamentals. We've got a lot of the sectors of our market struggling with weak prices or strong competition or numerous other factors. But yeah, with iron ore holding not too far from its lows, with the banks reporting fairly disappointing results in May, it's very hard to see our market breaking to the upside in the short term. Another reason that we might struggle to break to the upside is overseas markets are starting to look a bit toppy. This is the US S&P 500. It's been on a bit of an uptrend, but it is back to a pretty key resistance level at 4,300. That was the resistance level in August last year, and it was a resistance level before that as well. So if they hold these resistance levels and come back down, that's going to provide negative or bearish leads for the XJO over the sort of coming weeks. It's a similar story in Europe and Japan. A lot of their markets are at very, very high levels and could potentially run out of steam. What goes up must come down. So with these markets seemingly starting to top out after strong bullish runs, it's unlikely they'll provide those positive leads that our market might need to grind higher from its current level. So overall, yes, the US is still in an uptrend. Yes, it's been quite bullish, but at a pretty key resistance level, and would not be surprised to see a move back to trend or back to support levels. And given that's the case, it's hard to see bullish leads for our market, and so I think there's more pressure to the downside. Finally, I did want to touch on the ASX today. Very disappointing trading update. The stock was down 10% for the session, broke through some pretty key support levels that it's held for quite some time. In fact, this is lower than the lows that it reached in the global pandemic period. So really quite disappointing results from the ASX there, and it comes on the back of quite weak volumes on the stock exchange for Australia. Volumes have been fairly weak for the last few months. It comes after a few technical issues with some issues in trading warrants for the market. And I think you could say it comes after a fairly underwhelming operational performance from the ASX itself. Alright guys, that's it for this week. A surprise announcement from the RBA. Shocked the market, bit of downside pressure. Will we continue lower from here? We'll have to wait to see in the next one. I'll leave it there for now, but if you guys enjoyed, definitely let us know in a comment. Click the like button, click subscribe, and I'll see you in the next one.